using debt the right way can skyrocket your property investment returns. Property investors using leverage can experience in just 10 years a 69% increase in wealth compared to those who don't. There is a common myth that debt is bad, and that is particularly true, I believe, in my opinion, when we're looking at credit cards and loans, so personal credit, because that type of debt is serviced primarily from personal income. But when we're looking at investment debt, that debt is serviced via someone else, not us. So you benefit from capital appreciation and wealth creation, and someone else is servicing that debt. So when we look at debt that way, things start to look quite attractive. And it's the number one reason why property investors, when expanding their portfolio, use debt. It's to leverage their existing assets in order to obtain their long-term goals. There's a common myth that debt is bad, and in my opinion, that's particularly true when we're looking at credit cards and loans, so personal credit, because personal credit is serviced via income. Investment debt is serviced via someone else. So you benefit from capital appreciation and passive income, and someone else is servicing it. Now that's the number one reason why property investors use debt or leverage to increase the size of their portfolios to meet their long-term goals. To use leverage effectively, you need to understand two things: product selection and capital appreciation. Now, one of those things you can control, but the other one is completely outside of your control. Now, when you're looking to expand your portfolio and you're looking to use leverage to do that, naturally, you might be inclined to move forward with a 2-year fixed rate because you're only waiting 24 months, you can release the equity, expand the portfolio. That would make sense. But things get a little bit muddy when we start to look at, well, where is the property located? Is the property primed for enough growth for you to release enough equity for you to expand the portfolio? So when you're looking at product selection, and this is so important, you've got to think about the economic conditions of the geographical location that the property is situated in. So in other words, if the property is sitting in an area which is primed for growth and you think that there's going to be enough growth for you to release the equity and cover all of the costs of refinancing, perfect, 2-year fix all day long. But if you're buying in an area that perhaps historically has not had a very good capital appreciation rate, and there's not much going on in that area apart from perhaps a high rental demand currently, perhaps a longer term fixed rate would be more appropriate for you. Now, when it comes to capital appreciation, location is really key. Location drives capital appreciation. So there are certain areas in the country that are just not primed for capital appreciation. There are other areas in the country that are. So when you're looking to invest, always keep in mind your long-term goals. And the long-term goals are, well, I want to buy this property, I want the property to increase in value, I'm going to release that value and then redeploy that capital somewhere else to expand, then area is going to be a top priority for you. Did you know inflation actually erodes the value of debt? So house price inflation increases the value of properties over a period of time. But over a period of time, the value of the debt actually decreases. But the question is, if we're consistently releasing equity in order to expand our portfolio, is the debt actually eroding? Well, in my opinion, it's not, because we're increasing the debt level. The actual value of that debt might drop, but we're increasing the amount owed back to lenders. Now, is that a bad thing? Well, perhaps not, because every time you increase the debt, you're taking the value which is in one property and you're putting it into another. Now, to give you a bit of an example, the most successful clients that we have are pretty much leveraged up to around 60 to 75%. And they consistently do that because they have their long-term goals. Now, what's important to understand is if we're consistently taking out more debt to buy more assets, in this case properties, is the portfolio sufficient enough to service that debt? So what you've got to think about is when the debt starts to increase and the number of properties starts to increase, if one of those properties hits a void period, so a tenant doesn't pay or a tenant moves out, takes you a period of time to move another one in, will the portfolio, or is the portfolio sustainable enough to sustain that particular property? Now, if that is the case, then you've effectively used leverage effectively, which is a good thing. Now, what's also important to understand is once you get to a certain point, once you get to a certain number of houses or flats, reverse the strategy. Think to yourself, right, I've got to 10 properties. The 10 properties are generating £10,000 a month. I don't need any more money than that. But keep in mind that obviously the debt level is going to be elevated when you do get there. So most of that £10,000 that you're generating rental income is going to pay for servicing the debt. So at that point, stop acquiring. And then what you'll find is actually the value of that debt, because of inflation, will start to drop, but also because you're using the net profits and perhaps some surplus income, you can start to pay that debt down. That way, when you do hit your long-term goal, you'll have that £10,000. Obviously, you've got some taxes and expenses, but ideally, you won't have any mortgage debt. With any type of investing, there's always an element of risk. Now, I like to look at things from a risk profile perspective. So are you low risk, medium risk, high risk? So if you're low risk, perhaps the best strategy for you is to put down the biggest deposit that you can and aggressively repay the debt. Without any debt, there's very little risk. If the property's not let, you're not generating any rental income, but the amount of money to service the property obviously is minimized because there's no debt to pay. Now, if you have a bit more of a balanced approach to investing, a bit more of a calculated approach, I suppose, then using leverage to expand your portfolio will become second nature. And the way I look at it is quite simple. So if you have £1 million, you can buy one property. If it goes up 10%, you made 100 grand. But if you split that £1 million into 3 properties, and 3 properties go up 10%, you've made £300,000. Now that might sound great, but you've got to think of investing very carefully in very specific areas of the country. So always look at the type of property, the rental demand, will the area have, is the area primed for capital appreciation, all of those sorts of things. Now, if you can do that, then you will build a very successful business, and I'm sure you will hit your long-term goals. I recorded the video about SPV mortgages, what they are, how to obtain one, how they're assessed. It's a fantastic starting point for you to understand exactly why they are the go-to property investment mortgage product for property investors in the UK. If you'd like to learn more about that, click here. Thank you so much for watching.